Now, with Groupon's IPO causing so much debate, let's bring in a seasoned tech investor to get his take. Joining us today is someone who has a nose for picking stocks. Michael Cuggino has been president and portfolio manager of Permanent Portfolio since his firm, Pacific Heights Asset Management, began managing the fund back in 2003. It has $15 billion under management. His top tech holdings include HP, Intel, and Symantec, and the fund holds 2.2 million shares of Intel and 1.5 million shares of HP. But Michael, first of all, I want to talk to you about Groupon because, you know, we were talking about that earlier in the show. It's inspired kind of an intense controversy here in the Valley. Will you invest in Groupon when it IPOs?
No, we won't. And the reasons have nothing to do with Groupon per se. We generally want to see a 3-year operating history of a public company before we invest in them. So we generally don't get into IPOs. Having said that, you know, we're watching what's going on in the Valley like everybody else for potential investments down the road. And I think a lot of the comments that were made regarding valuation, regarding the growth of the business, what struck me particularly was the huge increase in marketing costs. And you got to wonder, you know, revenues, but at what cost, and where does that translate into profitability? And one of the things we're looking for, which sometimes is difficult in early stage companies, is to look for companies that are making money, cash flow positive, profitable companies. And I think the jury's still out on a lot of the newer companies coming out of the Valley with respect to great business models, great ideas, but the profitability question is still very much up in the air for a lot of these firms, Groupon included. Okay,
let's talk about HP, one of your biggest holdings. Obviously, they've made a lot of news. They're considering spinning off the PC business. What's your reaction to this? Is this something that you support?
Couldn't have come soon enough, actually. I was not a big fan of the Compaq purchase years ago. The PC business, I think, is always going to have a place. But I think it's a declining place, you know, especially with all the new devices that are coming out now. So I think going forward, it's a great longer-term decision, and I would probably applaud the management team for making it, despite some of the headwinds that they're going to face from shareholders and the media and just general consumers with respect to, you spent a bunch of money on this acquisition, it didn't pan out, it was crazy, you spent a bunch of money on Palm, you're going to write that off. You know, I applaud them for changing course. Now it's all about execution. We're long-term shareholders, so we're willing to give them time to execute the strategy, and I believe long-term it's the right strategy, but there's a lot to go from here to there.
Michael, Michael, let me ask you, how long are you going to give these guys? I mean, you know, the stock obviously is cratered on you here, and as you said, they're kind of flip-flopping, buying a company for $1 billion one year, writing it down to nothing the next year. How long are you going to give these guys?
Well, I mean, Apotheker's been there for, what, 6 to 9 months or something along those lines. I mean, clearly he needs time to develop his strategy. We're going to give that to him. I might look at the decline in the price as being overdone in the short term and maybe a buying opportunity, given the longer-term strategy. But I think also you are talking about execution, and we just don't know that. I also, sorry, Cory, go ahead.
No, so we had Todd Bradley on the show last week. I think it was last week. It was a long week. And he said that the PC division was worth significantly more than a quarter of its sales, which would be $10 billion. If they get less than $10 billion, would you be disappointed, and do you think they should keep it?
I don't think they should keep it under any circumstances per se, because I think over the long term it's a declining margin, declining business. I would prefer to see them, if they're going to focus on hardware at all, you know, the server side of things where they're having some success. And also they've made a lot of they've gotten a lot of attention for their forays into software services consulting. That's a higher margin, higher growth business, so I'd probably prefer to see them go in that direction. I think the key is they've proven that it's a downward slope if they're trying to do it all, and I think they're recognizing that as a company. And so, all right, make the commitment. Go to software, go to servers, go to your growth businesses. Even printers is probably a low margin business going forward. So focus in that area. You got a guy with a software background that's a CEO, so I'd assume he's qualified to take it in that direction. So so go with it.
All right, Michael Cuggino, we'll have to leave it there and have you back to talk more about this. Pacific Heights Asset Management, thanks so much for your insight on all of this.